Genesis HMAS Deconstruction Engine online.
We are examining the draft Form S-1 prospectus for Space Exploration Technologies Corporation, the foundational document for what could be the largest public offering in history. This document outlines a proposed public offering anchored to an implied pre-money enterprise valuation of $1.8 trillion. In high-growth sectors, markets often accept corporate forward-looking statements at face value, focusing on the sheer scale of the vision rather than the structural reality of the business. We are applying an adversarial baseline instead. This methodology uses a multidisciplinary stress test, combining forensic accounting, astrophysics, and corporate law to break through the document's narrative framing. The data reveals a structural imbalance. The entity is actively leveraging the cash flows of a standalone utility to fund unmonetized, highly speculative capital projects for its privately controlled affiliates. This architecture masks a liquidity crisis. Based on current spending rates, the consolidated balance sheet is accelerating toward a breaking point in the first half of 2027. Applying first principles logic to these findings dictates a severe recalibration of the asking price, requiring an 82.5% compression of the peak narrative value. Our forensic audit begins with the unadjusted, line-by-line operational run rates extracted from the first quarter of 2026. As the top green panel shows, the connectivity segment, which includes Starlink, is a viable, profitable utility. In Q1 2026, it generated an operating income of $1.188 billion. However, management utilizes a non-GAAP metric called segment-adjusted EBITDA to present the core launch business as profitable. This is achieved by explicitly excluding $3 billion in recurring Starship research and development costs. When we reintegrate that $3 billion into standard operational expenses, the space segment reveals its true state, a structural quarterly deficit of $662 million. This deficit is further compounded by the AI segment, which operates as a liquidity black hole. It lost over $2.4 billion in a single quarter, pulling the entire enterprise into a net cash bleed of nearly $2 billion every 90 days. Throughout fiscal year 2025, the corporation deployed $12.7 billion in AI infrastructure capital, yet the commercial revenue returning to the company from its primary affiliate, Tesla, was limited to just $2 million. This data identifies a severe transfer pricing vulnerability. The public entity absorbs the multi-billion-dollar capital risk, while private affiliates like xAI capture the resulting intellectual property and compute utility without providing fair compensation. Because the core launch business and AI integrations are structurally unprofitable, $180 billion must be immediately removed from the enterprise valuation model. We move now to the engineering claim driving the bulk of the valuation, the 2028 deployment of a 100-gigawatt AI compute constellation in orbit. This plan assumes space is an infinite cooling sink, but in a vacuum, convection and conduction are physically impossible. There is no air to carry heat away from the hardware. This creates a radiative bottleneck. As the Stefan-Boltzmann equation dictates, high-density silicon generating 100 gigawatts of heat must reject every watt of that energy exclusively through infrared radiation. To prevent the hardware from melting, the constellation requires 62.88 million square meters of radiator surface area. Managing that thermal load requires a minimum infrastructure mass of 981,000 metric tons. At 150 metric tons per flight, it would take 6,541 dedicated Starship launches just to orbit the cooling and power frameworks. That launch requirement only covers the infrastructure to keep the system cool. It does not account for the mass of the actual AI computing modules themselves. This is a narrative deviation, a strategy of projecting a distant sci-fi utopia to distract investors from the immediate reality of current cash destruction. Since first principles physics proves the 100-gigawatt constellation is logistically unviable, the $900 billion speculative AI premium must be liquidated. We turn from operational physics to the corporate governance architecture, which is built to insulate insiders from public accountability. As the governance block shows, the dual-class share structure locks in 59.58. Because Class B shares carry a 10-to-1 voting multiplier, the public float functions strictly as non-voting economic fuel. Institutional proxy resistance is mathematically impossible. The corporate bylaws further entrench this control by mandating the Texas Business Court as the sole and exclusive forum for all internal disputes. These bylaws explicitly prohibit class action shareholder lawsuits and waive the right to a jury trial, forcing all challenges into individual expedited arbitration. The entity has also adopted a 3% derivative gate from the Texas Business Organizations Code. This requires shareholders to maintain a continuous multi-billion-dollar stake for 6 months before they can even initiate a lawsuit against management, a financial hurdle that effectively neutralizes standard oversight. This systematic dismantling of public recourse demands an additional $135 billion governance risk discount on the total valuation. When we synthesize these adjustments, the $1.8 trillion baseline collapses. After pricing in thermodynamic constraints, normalized expenses, and governance risks, the true valuation is significantly compressed. But beyond the recalibrated valuation, the company faces an immediate existential threat. The enterprise is currently hemorrhaging nearly $2 billion in cash every 90 days. When we weigh the 11 quarters remaining until the 2028 deployment against the 3.5 quarters of available cash runway, we get a narrative deviation index of 3.14. Because any score over 2.5 indicates a structural dependency on outside funding, the organic cash flows are clearly exhausted. Forecasting this run rate against standard institutional debt covenants identifies a critical breaking point. Mathematical modeling signals a definitive liquidity wall arriving in the first half of 2027. To avoid a default, management has only 2 viable options. The first is the mass equity dilution track. This would require an immediate, unannounced $40 to $80 billion secondary public offering, which would severely compress the equity value held by early public investors. The second option is the distressed debt restructuring track, which would force restrictive institutional oversight and high-interest penalties onto the balance sheet. Ultimately, the draft Form S-1 functions as an intricate architecture designed to insulate insiders while shifting the total weight of operational risk onto the public market.